Welcome to Talk Tickers. Today we're diving into one of the most confusing earnings reports I've seen in a while, from Circle. I mean, on the surface, their Q3 looked like an absolute blowout, a huge win. But then you look at the stock, and it was a total catastrophe. So what's the real story here? Let's get into it.
Okay, so let's start with the headline number that should have sent the stock soaring. Circle reported earnings of 64 cents per share. Now, you have to understand, Wall Street was looking for something in the ballpark of, maybe 18 to 34 cents. So this wasn't just a beat. This was an absolute demolition. They crushed the high-end estimate by more than 90%.
And yet, this is what happened. The stock got hammered. It closed the day down a brutal 12.2%. And check this out. The trading volume was more than 3 times its daily average. That tells you investors weren't just trimming their positions, they were rushing for the exits.
So what gives? A blowout quarter meets a massive sell-off? What on earth did the market see that the headline numbers missed? Well, this is one of those classic Wall Street mysteries, and to solve it, we've got to look way past the headlines. We're going to break down the amazing results, unpack the grand vision management laid out, and then we'll find that one little detail in the forecast that scared everyone away.
All right, first up, let's build the bull case. Let's look at all the reasons this stock should have skyrocketed. Because honestly, by any traditional metric, this quarter was an absolute home run.
Just look at these numbers. The growth is just incredible. Total revenue up 66% from last year. Net income more than tripled. And the real engine of this business, USDC circulation, it more than doubled to almost $74 billion. I mean, come on, that is just staggering growth.
And this chart really puts that earnings beat into perspective. It just shows you how completely wrong the analysts were. That 64 cents per share wasn't just a little better than expected. No way. It was more than double what the most optimistic analyst on the street was hoping for. A true blowout quarter, plain and simple.
So you can imagine, with numbers this good, management was feeling pretty confident on the earnings call. And they used that opportunity to sell this really grand vision for the future. A vision that's way, way bigger than just being the company behind USDC.
And here's the core of that vision, straight from the CEO, Jeremy Allaire. He talks about this collision between open internet infrastructure and the global financial system. So what's the big idea? They want to build what they're calling an economic OS for the internet. Think about that. They don't want to just be another app on your phone. They're aiming to be the foundational plumbing for the whole digital economy.
So how are they going to do it? Well, they're tackling it with 3 main pillars. First up is the ARC network. This is their own brand new blockchain built for financial apps, and it's already in a public testnet with some huge names kicking the tires. We're talking BlackRock, MasterCard, and Visa. Second, they have the Circle Payments Network, a global system that's already live in 8 countries and growing fast. And third, they're pushing into tokenized assets. Their USYC tokenized money market fund, for instance, has tripled in size to $1 billion just since June. That shows you the institutional demand is absolutely real. Okay, let's pause here. The results were fantastic. The vision is massive and compelling. So, what gives? What could possibly justify a 12% nosedive in the stock? This is where the story takes a turn.
It all came down to the guidance for the future. You see, the market doesn't just care about what you did last quarter. It cares about what you're going to do next. And buried inside all the good news in their forecast was one specific detail that overshadowed everything else.
So here's the breakdown. On the left, the good news. Management raised guidance for their other revenue stream and for margins on their core business. Awesome, right? But look at the right side. They also raised their guidance for operating expenses, and not by a little. This was a clear signal that they're about to start spending a whole lot more money.
And that brings us to the 2 big fears that really grip the market. First, those rising costs. Higher spending means lower profits in the short term. Simple as that. But the second fear, that's the big one. It's about interest rates. You have to remember, a huge chunk of Circle's revenue comes from the interest they earn on their USDC reserves. With the Fed hinting at rate cuts on the horizon, the market is looking ahead and thinking, wait a minute, that primary revenue engine is about to slow down a lot.
So where does all this leave the stock? We've got this amazing past performance clashing with a pretty uncertain future. Let's get to our take. Here's our outlook for the next quarter and our official rating.
All right, so after digging through all of this, we're initiating our coverage on Circle with a market perform rating. Why? Because honestly, this story is just too complex right now for a simple bull or bear case. There's just too much pushing and pulling. Our whole thesis boils down to this. The stock is caught in a massive tug of war. On one end of the rope, you have that incredible growth engine, more USDC adoption, new platform features, but on the other end, you have the market's fears about shrinking interest income and rising costs. We think the stock is probably going to be stuck in a range, just trading sideways until one of those forces clearly wins out. So what should you be watching for? 3 things: the mainnet launch of that ARC network, how fast that high-margin other revenue grows, and any word from management about getting those costs under control.
This is not financial advice.